All right, welcome back, traders. John Caruso here, Senior Market Strategist with RJO Futures, and this is another edition of Rolling Trades. Today we've got a couple slides prepared for everybody. We're mostly going to be going through a little bit of the macro. We're going to hit on some of the employment situations that are going on right now. We're going to go through a little bit of my trading process and how I analyze markets, and then, of course, we're going to take a look at some of the charts here. So we're just going to jump right into it here for everybody. Let's flip on into the key events and employment here. Last week, we did see the U.S. government shutdown come to an end. That was a record 43 days that lasted. We are starting to slowly see some of the economic data that we missed start to trickle in here over the last several weeks. But we just did hear from the BLS just recently that October employment data will not be released, and that's likely never to be released. And that's going to be something interesting. We were kind of analyzing some of the recent challenger job cuts that we saw from back in October, and they were pretty atrocious. We did see 153,000 job cuts in the month of October, which marked about 175% year-over-year increase. So I'm very curious as to what those October unemployment numbers would have looked like, but I guess we will never know at the moment. So taking a look at yesterday, we did see Nvidia post strong earnings, strong EPS and revenue growth, staving off a deeper correction in the indices. We did see the S&P 500 drop along 6,600 recently. That marked the 5% correction line. We did see the NASDAQ drop off, correct roughly about 7.5%. We are seeing, post the Nvidia earnings release, we are seeing the market stave off a deeper correction for now. We have seen some of our volatility instruments come in as well, which is what you want to see for a continued rally into the end of the year. But as I'll show you on the charts here momentarily, I still don't necessarily think we are out of the woods just yet. Of course, this morning we also did see the September payrolls number come out. So we kind of had a surprise employment day this morning. However, that is pretty stale data coming out from September. 119,000 jobs were created in September. The expected number was 52,000. However, we did see an uptick in the unemployment rate to 4.4%. And as we all know, currently the Fed is odds of Fed interest rate cuts or them holding steady. A lot of that hinges upon the employment data. So strong September payrolls number. As I mentioned, that October challenger job cuts figure that came out up 153,000. That is the biggest number that we've seen, or the worst number, I should say, that we've seen in the last 20 years. So I don't know whether or not the Fed is going to take that into account when they make their interest rate decision in December, but that was certainly something that was startling to see. In this chart that I have up here, you can see the reasoning, corporate reasons for the job cuts back in October. Actually, this is going to span the first 10 months of the year, as well as zero in on the October. So you can see the year to date right here, which we have seen year to date up until that October period, 1.1 million layoffs in that 10-month period, which marked a 65% increase on a year-over-year basis. And you can see some of the reasons that these companies were listing for the job cuts, and you can see this little sliver right here. That is artificial intelligence. So a lot of the narrative right now that AI is replacing jobs, that is largely just a narrative right now. And the biggest reason for them for the job cuts year to date were coming from were companies citing market and economic conditions. So you wonder if we're getting the full picture right now, and economic conditions are weaker under the surface than what some of the data is telling us right now. So let's flip over. We're going to take a look at this is my personal TRM grid. The TRM grid, that is trend, range, and momentum. And we've got some MACD notes out there. This is kind of the technical process or quantitative process that I go through on a daily basis to analyze these markets. You can see on the left-hand side here, you've got the S&P 500 still signaling bullish trend. We've got an immediate-term range. Momentum currently negative in the S&P 500. And the OBOS, this was taken, mind you, at about 6:30 this morning. That has actually crept into immediate-term overbought territory. So you're going to watch that. Anything over 80 is considered immediate-term overbought. And, of course, we still have the volatility signals, the VIX, still hovering around that 20 level. So we might not be out of the woods just yet in terms of market volatility. And we're really going to be watching that 6,600 level as a key level. So I compile all this data on a daily basis. We've got our MACD notes. I do like looking at the MACD. You do start to see those crossovers, which could tell you that we are starting to see the beginning phases of a trend change. I do like to use that indicator kind of paired with my OBOS momentum and, of course, our trend in range analysis. So that is just a quick look at my technical process in how we analyze our entry and exit points in markets. Flipping over, taking a look at the S&P 500, as I mentioned, saw a 5% correction, hit 6,600. We did hold. That was very important from what we thought that should happen for this market to, if it is going to continue higher into the end of the year. Thought that 6,600 level was a key level, 5% correction line. Of course, we're starting to see some anxieties over the Fed and the odds of them cutting interest rates in December. A lot of that is going to kind of hinge upon the strength in the labor market or the continued deterioration in the labor market. Also, anxieties over AI valuations. Seen some weaker guidance by some major AI players. But with the recent Nvidia earnings kind of putting to bed any fears over an AI bubble, that is one of the reasons why we're starting to see some strength here today in stocks. So taking a look at that chart, this chart is innocent until proven guilty, in my opinion. This is clearly a very strong upward trend that we've been experiencing since Liberation Day back in April and the announcement of the tariffs. So this currently, obviously, we saw this little bit of a check down that we saw along 6,600. If we are to break 6,600, the next downside targets would probably be this old swing low over here. But so far, we are staving off a deeper correction, and I still think that we can move higher into the end of the year. However, we still might not be out of the woods in terms of near-term volatility. So looking for, perhaps some more volatility over the next 2, maybe 3 weeks before things perhaps flatten out and we can get a year-end rally. So still looking for that year-end rally in the equity space. Flipping over, taking a look at gold. Gold, this is a market that we've been trading very actively for the last 2.5 years now. If we go back to this period right here, this was about April to September. We just saw a massive consolidation period for gold. And the longer you see that consolidation period or that compression in the market, the bigger the breakout or breakdown. It could also break down. But in this case, of course, we did break out higher. The longer that compression period, the more aggressive the breakout that you're going to see. And that's specifically what we've seen here in gold. Gold, since hitting that high up around 4,400 and seeing that check down into 3,900, we've largely, to me, looks like we're trying to settle into a trading range here. And to be honest with you, at the very moment, I can't tell you if we're gonna revisit 3,900 or revisit the all-time highs. What happens first? But ultimately, I do believe we are in a trading range. We are still carrying core long positions. If we were to see the market drop back along 3,900, I would imagine that we're going to be grossing up those core longs. But right now, sitting just simply with the cores, waiting for the next major break higher or lower in that market. So still remain largely bullish on gold. The dollar debasement trade, that's been a big narrative for that market. Central bank demand remains insatiable. I don't think that is going to change anytime soon. And I still think gold prices out into 2026 will experience higher price momentum. Switching over, we're going to take a look at silver, very similar to gold. Saw a little bit of that compression back here in gold. Saw that diamond pattern formation, compression, and then we saw the breakout and the melt higher. Silver actually, after reaching 53, reaching the all-time high, I believe it was 53.76, did experience a little bit of a drawdown here, and then we went back up, re-challenged those highs, actually took out the highs, and now we're kind of pulling back here a little bit and settling into a range. Same thing as gold. I think the range right now you trade is between about 54 on the upside and about 46 on the downside. Large trading range. So similar to gold, can't tell if we're going to revisit 46 or re-attack 54 over the near term. We are still bullish on this market. I would imagine if we were to revisit that 46 level, we'd be looking at grossing up long positions and simply trading that within the guidelines that we use every single morning in our TRM grid that I just showed you guys momentarily ago. Fifth consecutive year of supply-side deficit for silver. It's still obviously carrying precious and industrial metals qualities. We did see silver just get added to the critical minerals list by the United States government, so that's going to make things interesting going out into 2026. The other thing I want to call out is right now we have the market in backwardation. We have spot silver trading about 20 cents over the December futures contract. So that is telling you that there is very tight supply and high demand over the very near term of that market. And of course, that could potentially set the stage for a price squeeze in the not too distant future for silver. So I do see extraordinary opportunities in silver ahead. As I just mentioned, tight physical market being highlighted by backwardation. Taking a look at crude oil. I have not traded a crude oil contract since probably back in April, to be quite honest with you. When I look at that market right there, I'm seeing a lot of chop. I'm seeing the dominant trend is still lower, albeit it is grinding lower. I am still looking for crude oil to make one final descent, perhaps down into 55 to potentially 54 once more, before perhaps that is a pretty good buying opportunity going out into 2026. I do think we will see more expensive energy prices as supply tightens and OPEC begins to slow the pace of production increases. So I do expect some tighter supply, specifically in the first half of 2026. We do have the economy reaccelerating in the first half of 2026, and I think that's going to feed into higher energy prices. And the market pulse. I write the market pulse on a daily basis. We hit on a lot of these subjects. It is a free market insight note that I've been writing now for about the last, I want to say, 12 years. If you want to jump on that list, feel free to ping me at jcaruso@rgofutures.com. We'll get you on that list free of charge. We also do put out some directional market timing signals inside of that market pulse as well. So if you're taking a look at some of how some of the things we're doing and how we're positioning in markets on a daily basis, just feel free to simply ping me at jcaruso@rgofutures.com. So that's all I have for you today. Best of luck to everybody out there. If you have any questions, feel free to reach out anytime. We will catch you back here next time. Have a great one.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.